Good morning, everyone. Thank you so much for being here. I'd just like to repeat what Nick said. It's wonderful to see so many of you. Am I in the right place for the microphone? Yep, okay. So the format of today's presentation, we will take you through a little introduction of what MIGO Opportunities Trust does. Then there have been a few changes to the trust, so we'll talk a bit about that, both on the portfolio side and the corporate side. And then finally, we will take you through what's in the current portfolio and where we're seeing the best opportunities. So just to start off, what is it that we do? As Nick said, we are an investment trust looking for discount opportunities in the closed-end funds sector. We think that this is a very exciting opportunity for MIGO. There's obviously a huge amount of discounts around. And because of the way we invest and what we invest in, we tend to have very low correlation to wider equity markets. And in a period where we've got increasing concentration and everyone seems to be sort of one way on the AI bet, we think that MIGO offers some great diversification in comparison. Now, not all discounts are made equal, and so it takes an awful lot of work and detailed research to find the best opportunities, and this is where we feel that we add real value with our intensive research, detailed models, IRR scenario analysis, private transaction analysis, expert networks, to really ensure that we're finding the best opportunities in what is currently a wonderful sector. So how do we create returns? Well, there's two ways that we get returns from discount opportunities. First of all, that top graph, where you can see that we've got a NAV going up, that discount narrowing, and that's a really powerful combination for returns. But what we're seeing more often in this market is that bottom graph, where we're seeing a considerable amount of corporate activity, whether that's mergers, wind downs, takeouts, and the investment trusts are being taken off the market, and that share price is going to NAV as part of that transaction. Just to put a few numbers to that, this is currently the amount of investment trusts going through various mergers, acquisitions, strategic reviews, etc. So the opportunity set is huge, and you can see that we've got various examples that have been in the portfolio or are currently in the portfolio that are going through these kind of corporate actions and corporate activity, and we think this will be a real driver for returns going forward. And why are there so many discounts in the investment trust world? Well, we had an enormous boom of issuance for about 10 to 15 years post the 2008 financial crash, where interest rates were incredibly low. And a huge amount of investment trusts were launched in that alternative income space that provided a 4% yield to pretty yield-starved investors. What we've seen more recently with interest rates going up, that most investors have moved back to more traditional sources of income, driving discounts wider, particularly in that alternative income sector. As you can see from the graph, discounts have narrowed moderately from their real lows in 2023, but there's still a huge amount of value on offer throughout the sector. Just a quick overview of MIGO. I think there's a couple of things that is important to pull out here in terms of the trust. So the trust is still relatively small at 70 million market cap. We are looking to grow this, particularly because of, as I said, the fantastic opportunity that we're seeing in the sector. What I would say is that our own discount is very narrow at 3.5%, and we buy back an issue in order to keep the supply and demand in equilibrium in the market, because we think our investors should enjoy the discounts in the underlying opportunities rather than suffer any discount at our trust level. We do have some gearing, and that's due to the fact that we have far more buy ideas than sell ideas at the moment. I will pass over to Tom, who's going to talk to you through the portfolio changes that we've made in recent months.
Thanks very much, Charlotte. So I'm fairly new to MIGO. I was appointed as co-manager alongside Charlotte in June 2025, but I've been involved in the investment trust world for a long, long time. Been at AVI for 14 years or so, and very much focused on the investment trust and closed-end fund sector. As Charlotte says, when I came on board to work with Charlotte in June of this year, we also made some tweaks to the investment approach. We're still very much focused on investment trusts, trading at deep discounts to NAV, looking for catalysts, but we have evolved the offering in a few key respects. The main one being, and the most tangible one that you would have seen already, is an increase in conviction expressed via fewer holdings in the portfolio. So we've gone from around 50 holdings going back a year or so ago to around 30 today. And the long-term aim is to get that down to around 10 to 15 core holdings. Why do we want to do that? There's a couple of reasons behind it. One, we do a huge amount of work on the underlying assets that we own. We are looking to develop a thesis on why the discount will narrow. We're looking to take a view on how credible, how real the NAV is. And if we do all that work and it's a 1% position and it doubles, great, it's helpful. But we really want to have greater conviction in those holdings so when the thesis does actually pay off, it has a meaningful impact on the MIGO NAV per share. Increased activism and engagement. This is something that we think is a core skill set in closed-end funds, but particularly even more so. As Charlotte said, we had a 15-year boom in issuance where anything with a 4% yield traded at a premium for a long, long time. Since we had the inflation scare and the rate hike cycle beginning in 2022, we've seen the alternative sector go to deep discounts to NAV. And we're very engaged there with boards on particularly capital allocation. And I go into that in a bit more detail later on. More event-driven investments. Now, we can be a catalyst ourselves. We can create a catalyst for our engagement, but we're also on the hunt for more organic events as well. Perhaps the fund is facing a continuation vote on its future. Perhaps it is coming out of the index, going into the index, etc. And given how inefficient the market is, that can create opportunities for alpha. Finally, on the changes, we're going to have, and we have already got, lower underlying look-through equity exposure. There's a few reasons for that. Firstly, we think that with markets, or rather with broad markets where they are, very toppy, as Charlotte said, can be boiled down essentially to a single bet on AI CapEx. We're very comfortable having lower beta in the portfolio. Secondly, we can add a lot more value by analysing the alternative assets. There are some NAVs that are more real than others, and we can do a lot of work to ascertain how credible the NAVs are. And thirdly, it's really a result of the current opportunity set as well. Equity trusts today trade on average, the top row there, at a discount of sub 10%. But you can see very clearly there's much wider discounts on offer in the alternative sector. So that's really where you can expect MIGO to plough its furrow going forward. Just a word on the transition to date. Today, if we update this chart to today, we have 30 holdings. As I say, that's down from a peak of 50 a year ago. And the concentration has increased to around 58% today. Sorry, the top 10 rather, being 58% of total NAV. The plan is to get to the final MIGO 2.0 proposition in stages. We're probably, I guess, around a year from that away. What we're not willing to do is to do a fire sale of assets to get there. So returns are definitely coming first there. So I mentioned the increase in activism. I mean, there's a lot of detail on this slide, but I think the overriding question facing boards today when they're trading on big discounts to NAV is very much one of capital allocation. And the main point we would make to boards, and we do make to boards, is if your shares are trading on a 20, 25, 30 discount to NAV, there's almost certainly, with very few exceptions, no better investment you can make than buying back your own stock. In terms of our approach to engagement, we highlight it quite nicely with this graphic here showing the iceberg. The point is that we engage with every company in the portfolio, both with board and management. The vast majority don't see the light of day, however, and it's only very rarely that our activism spills over into the public. Now, the very fact that we are willing to go public and have the experience of both the legal work and the media work required to go public means we very often achieve what we want in private. Just to finish off here, there's a couple of unnamed examples here which I think highlight very nicely that the new approach, or rather the revised approach, won't just apply to new holdings in the portfolio. We have two unnamed, long-standing MIGO holdings here where we own meaningful stakes in the company. We think the shares are very cheap. They perhaps don't fit into MIGO 2.0, but our approach there is to engage with the board and facilitating exit much closer to NAV than to the current share price. Just back to Charlotte for the corporate changes.
Thanks, Tom. So as Tom said, there was some corporate changes we did. Obviously, the biggest one being stood next to me. It was Tom taking over as co-manager as Nick Greenwood, the long-time co-manager, stepped down. Obviously, I've been on the trust for 8 years, so it's a nice combination of new blood and some continuity. We think it's a really good team mix. And then we've spent some time, it gave us the opportunity to kind of take a step back and have a look at MIGO as a vehicle. And what we wanted to do is really create the best in class in terms of governance and in terms of the way that we run MIGO, so that we were aligned with shareholders as far as possible. And we thought that MIGO would survive another 20 years and thrive going forwards. So before I talk in detail about the corporate changes in terms of the fee and the capital redemption, I'll just take you through a little bit of what we're seeing in the sector, what we see going forward for the sector, and where we think MIGO fits in. Briefly, obviously we've talked about the team. We also have further support within the AVI stable. So Scott Beveridge is a property specialist, which is extremely useful when we have a considerable amount of REITs in the sector. And Ross is also an analyst that's been working on some of our private and venture holdings, and I'm pretty sure he knows more about Starling Bank than the Starling corporate team at this point. Mm-hmm. So as I said, I'm going to take you through a little bit. I'm going to stand away from that mic. So I'll take you through a little bit of how we see the investment trust market shaking out over the next few years. Obviously, we've had a lot of people say, well, is this the end of the investment trust market? Where are the buyers going to come from? What are we going to see with investment trusts? And we think that that's personally overdone. We do think that investment trusts have a role. They are the perfect vehicle if you would like to access illiquid asset classes, or particularly in alternative space, or something like UK microcap, or indeed investment trusts. What we do see, however, is that there'll become a bifurcated market where your big trusts that still have a considerable amount of liquidity, they will be used, and then your smaller trusts that will be doing something different, we think MIGO fits into this category, will also have a space for investors. It does mean, however, that these smaller trusts need to be doing something very different, as I said, preferably in something like an liquid asset class. They also need to be using gearing. They need to be making sure that their discount is under control, and we think that is the right place and the right strategy for smaller trusts going forwards. So we changed two things, two particular things in terms of the corporate side. The first is a capital redemption mechanism, and I appreciate this is really going against the grain of what everyone's been saying around investment trusts for the last sort of few years, which is bigger is better, you need to get bigger, merge, issue stock, etc. What we're looking at here is ensuring that we are able to create returns and the best returns for shareholders going forward. And we think that capping MIGO at 150 million means that we can invest all the way across the investment trust piece. We can find the best opportunity set. We're not too big. We're not too cumbersome. It's not like trying to turn a tanker in the middle of an ocean. We can be nimble and find the best opportunities. And I appreciate this is going against the grain of what we've seen as a trend in investment trusts, but we think it's the right way to run money in this area for shareholders, maximising returns rather than look at asset gathering. What we've also put in is we have reduced our management fee. So it used to be 65 bips, 0.65%. It's now 35 bips, so we've nearly halved that management fee. However, the quid pro quo is that we have introduced a performance fee. So again, what we're really focusing on is prioritising returns for shareholders rather than asset gathering. So we only get paid when we perform for our shareholders. We have capped that performance fee at 2.5%, which we think is very important. And finally, to really ensure that we are aligned as far as possible with shareholders, we've also said that we will invest 25% of that performance fee into MIGO shares. So we think that this really creates a situation where MIGO is best in class for governance and creates the trust that will thrive and survive for the next 20 years. Finally, to round off, and we'll go through this reasonably quickly so we have plenty of time for questions at the end. is the current portfolio, which is usually the bit that everyone's particularly interested in. So here is our top 10. You can see that the average discount is around 31%, very, very high in comparison to historic levels. We think there's an awful lot to go for, particularly because there's several of these trusts within the top 10 that are in wind down. And so we know that those discounts are going to zero. It's just whether that share price goes up to meet the NAV or the NAV comes down. We think we found some fantastic opportunities, and Tom will take you through the wind-ups as a theme a bit later. And as Tom said, we've increased the top 10 as a percentage of assets for greater concentration, greater conviction in our best ideas. In terms of how have we changed in terms of the asset class breakdown, you can see that red chunk at the bottom, which was equity. That's considerably smaller than it was previously been. But the renewable energy infrastructure we think is an interesting area. We talked a bit about the opportunity set and alternative income. This is an area that's been particularly hard hit, and that's increased considerably since over the last 6 months. And I will pass back to Tom, who's going to take you through a couple of themes in the portfolio where we're seeing exciting ideas.
Thanks, Charlotte. So I'll rattle through this fairly quickly so we have plenty of time for questions at the end. I won't go through every name on this list here, but I think a key point to note is how diverse the underlying assets are here. You have VH Global Energy Infrastructure, so you have Australian solar, Australian batteries, Brazilian hydro in there, US oil terminal storage in there. GCP Asset-Backed Income is an infrastructure, mainly real estate debt fund, and US Solar Fund is, as the name suggests, a US solar fund. The thing they all have in common is that they are all in what we call a managed wind down, or often done as a runoff as well. And as Charlotte said, the key factor there and the attraction for us is that you know for sure that discount is going to zero. They're going to hand money back to you at NAV, therefore eliminating discount on that portion of cash. The big question is it the share price, is it the NAV rather coming down to meet the share price, or the share price going up to meet the NAV? And what we're really trying to do here is construct a range of outcomes for each investment in the portfolio in this category. So in our downside scenario, we're quite punitive on time taken to realise assets, on haircuts, on more troubled assets. And we're really aiming there to find a situation where our downside scenario is we might make a little bit, we might lose a little bit, but broadly a flat return. But in our base case or upside scenarios, we're making IRRs of 15, 20, 25% plus. Listed private equity is a sector that's faced very persistent discounts for a very long time, and we think it's got to a point where the status quo is no longer tenable. I'd highlight we actually sold out of Oakley recently to increase our holdings in Pantheon International and Harbourvest. Both of these are ultra-diversified funds of third-party PE funds. And if you take HVPE or other Harbourvest as an example, under shareholder pressure, they brought in a number of changes, the most important of which is a continuation vote set for July 2026. Now, we think if the discount then is anything close to what it is now, 35% or so, there's very little chance that they actually pass that vote, and that should then precipitate some sort of event that gets us out at NAV. We think that the vehicle may well go into a runoff at that point, which will take a very, very long time, given the commitments they have and diversification there. But we think some sort of private solution involving a manager could trigger a much quicker exit and quicker return of cash for shareholders. Just to wrap up, I think what this slide shows here is how diverse the underlying sectors are. Again, so we have Georgia, that's the country rather than the state, private equity, public equity, Seraphim Space, energy efficiency products, life science, REIT, etc., biotech, US renewables. So despite going down to fewer holdings, it's still a very diversified portfolio that gives you quite a nice spread of risk. To conclude, the opportunity set, as we see it, is the best I can ever recall in the sector. We have a very attractive combination, not only wide discounts to NAV, but very heightened corporate activity. and we plan to position MIGO to benefit from that over the coming years. Thank you very much.
Well, thank you both very much. Very interesting. I'm sure we have lots of questions from this very packed room. Would anyone like to start us off? Yes, please. If you wait for the mic, thank you.
Hi, thank you for a very interesting presentation. I am a shareholder, but one of the questions that I've got is, if your overall thesis is right and your target audiences or your target market, as it were, begins to merge or a shrinking number of trusts, their size will increase. And is there not a contradiction between you wanting to cap your size? How are you therefore going to maintain a meaningful shareholding impact upon an ever-increasing size of your target market?
Yeah.
So do the two actually support, those two things actually contradict each other, or?
Yeah, I think that's a great question. I think there's a couple of answers to that. I think, first of all, the fact that MIGO is becoming greater conviction means that we'll have more money in our top 10, for example, and so we'll have larger stakes in our underlying holdings. I think, and I touched on it in the presentation, is that there will be trusts that will merge and get bigger and bigger. But we also think that there will be a space for smaller trusts to continue over the next few years as well. And so we want the ability to be able to invest all the way across the market cap piece. We tend to not find as much excitement in the really, really big trusts. They tend to be trading at much narrower discounts. They tend to be well researched. They tend to be very popular. They tend to be very liquid. So we will always be more further down the market cap spectrum. So capping the size shouldn't be too much of a problem. In terms of engagement, we don't think that being small is necessarily a problem. And I think, what we saw with Saba, you can have 29% of a investment trust and still not put through succeed in getting anything through an EGM. What we think is really important is actually building consensus within a shareholding list. And that's how that tends to be how you're more successful in doing activism engagement, is getting a consensus with lots of shareholders about the best way to move the trust forwards.
Any more? There's a question right over there.
Oh, yeah. Actually, just following on from that answer that you gave, when you engage with a company, especially as you're quite small, why do they actually listen to you? Because you're not, and especially something like HarbourVest, which have significant backers sitting there, and you come along as a small fund, why do they listen to you? So maybe if you could talk about, I don't know, a couple of examples. I myself personally invested in HarbourVest, in Sherborne, in Pershing Square. All got really big discounts. All of which HarbourVest, something's going on there, obviously, as long as the asset value is actually correct, because private equity valuations, pretty difficult. But Sherborne, what's Sherborne see, what's going on there. And in Pershing Square as well, massive discount that it sits on. So it's really, how do you get these things to change? Or are you just sort of riding on the coattails of much larger funds that are coming in there, which is obviously a perfectly acceptable way of doing things?
I think the answer to that is in part what Charlotte said in response to the previous question, actually, that I think Saba have showed it's not necessarily about the size of your stake. I think it's about the quality of the ideas that you put forward. So we've been doing this for a long, long time. We know most of the shareholders in the sector. We can pick up the phone, go in to see them, put forward our proposals to them. And what we tend to find is that a lot of boards will play divide and conquer. They'll often say to you, you're the only one calling for X, Y, Z. What you find is that is very rarely the case. And if we can then speak across the shareholder base, form a consensus view, and take that view to the management and or the board of the company, that's then very, very powerful. And the second point, as it pertains to the quality of our ideas, is that we've been doing this for a long, long time, again, and we have a very clear idea about what causes discounts, and what measures can be brought in to eliminate discounts as well. It's really about those years of experience. In the specific case of Harbourvest, AVI Global Trust, which I also work on, also owns a stake there. So our stake across AVI in total is around 3% or so. We've been very engaged with the board there. We continue to be. We've been pleased with the measures that they've brought in so far. We think the NAV is broadly credible. When they exit investments, it tends to come at an uplift to where they're marked in the books as well. And we think that the share price, or rather discount today, constitutes a very nice each-way bet, in essence. Either the exit market picks up in the US, exits come through at premium to NAV, NAV performance improves, discount narrows, great. But if it doesn't, as I say, you've really got to call into question the future of the vehicle. If it's still trading at a 35 discount to NAV, come the time of that vote next year.
I think perhaps just to do a really quick final point on that, I think in terms of activism engagement, it is a skill set, and it's certainly something, MIGO only came over to AVI 2 years ago, and it's definitely been something that we have learnt a huge amount about since coming to AVI, and AVI have been, very active in activism engagement for 40 years, and it certainly is a skill set. So it's very time consuming, it's not particularly easy. And so often what you find is some of the bigger companies who have a big shareholding of something are delighted for somebody else to be taking up with the skill set, with the knowledge, with the experience. They're absolutely delighted that someone else is taking up the mantle of getting it done. They're happy to sign a letter, and everyone's a winner. So I think there's a couple of things there.
Another question over there.
Thank you. What is the rationale for your benchmark? And frankly, it does look rather undemanding. Should it not be more demanding, particularly as you make demands on your underlying investments? So secondly, what, if any, dividend policy do you have?
So the benchmark is sort of legacy. It was the benchmark when the trust was launched 20 years ago. And the thesis of why it was that when it was launched, which still sort of applies today, is that it means that you're sort of index agnostic. The problem is that there's not a particularly good index that we could benchmark ourselves against. So the closed-end fund index, for example, that is mostly 3i and Scottish Mortgage, which feels a bit of an unfair marker, obviously, and therefore, what would be the appropriate benchmark? That's quite tricky to suggest. I think you could definitely argue that it was not a hugely difficult benchmark maybe 5-10 years ago. It's certainly got a lot harder more recently. What we also said when we put in the performance fee was that our performance fee isn't just our benchmark, it is our benchmark plus. So it's SONIA plus 3, so that's around 7.5% at the moment, which is reasonably challenging, and we only get paid returns above and beyond that. So, I think it's a combination of the legacy, the difficulty of finding what it would be appropriate, and also, as we understand that, we have used a higher benchmark as our performance fee.
We've got one question here in the front row. I'm sorry, I know there are lots of questions. We're not going to get to them all. One right here in the front row. Thank you.
Thank you for a very interesting presentation. I've had MIGO on a very lengthy watch list for quite a long time and buy into the principle, but principles are fine and delivery is something else. And looking at your figures in the last 3 months when markets have been ramping away fairly actively, you've delivered a return of 0.81%. And over a year, when markets have also been ramping away fairly actively, you've delivered 4.1%. I don't find that entirely encouraging, and I appreciate that the future matters rather more than the past, and there are strategy changes in place. But a number of them would certainly have been in place, say, 3 months ago. And I wonder if you could comment on the underperformance in that period of time, and why you might persuade me that your philosophy might deliver as well as sounding good.
Okay, thank you. I think the important point to make there is that in our view, and I think it's becoming increasingly recognised, is that The equity market today, particularly in the US and by extension the MSCI world as well, is incredibly narrow, and it's got more and more narrow. So you have a huge concentration in the US, within that huge concentration in tech, and within that huge concentration on essentially a bet that the $60 billion a quarter in AI capex will pay off. Now, returns have been driven by that very narrow cohort of companies. And what you should expect from MIGO really is that in a roaring equity bull market, we will lag. Absolutely.
Sorry, we're going to have to rush a bit.
Sure. Absolutely will lag. In a flat to down to slightly up market, we would expect to outperform. Return on MIGO will be lumpy. It will be driven by idiosyncratic events paying off, say a wind up, a take private, a merger being announced. So I think that really just speaks to the diversification benefits of MIGO within a broader portfolio and the very low correlation that we have with broad equity markets.
Tom, Charlotte, thank you so much. Thanks for all your questions.